Hey traders, Nick Shaheen here looking at the S&P after the Fed statement and more importantly after the Fed Q&A session with Jerome Powell. I can't believe the confusion that I'm hearing out there from the experts. The market this, the market that, he did this and he did that. I can't believe what I'm hearing. Anyway, so here's what happened. The markets were fine. In fact, the small caps were up 1%. Or 0.6%, 0.7% last time I checked, and powering through. Markets were flattish green ahead of the statement. And then the statement comes out, nothing much changes. It was fine. They cut quarter point. They said the same thing regardless as far as all the other stuff that they usually say. They added to the cut. Okay, they didn't cut 50 basis points, but they cut a quarter. And they revised their range. And also, more importantly, they expedited their ending of the QT. So far they have been doing quantitative tightening, which is getting rid of their balance sheets. You know, before they were buying, now they were selling, and they ended that 2 months early. So that's another equivalent of some cuts. But not a lot of people are talking about that. Everything was fine. The markets hardly moved. And they reacted the way they were supposed to, and the levels held. And then they started the Q&A session, which, let's end it there. Why the heck do we have those? Do they assume we can't read? I mean, write the statement, choose your words carefully, and stop with the nonsense and the bullcrap of idiots spewing their guts out without even thinking about it. And I'm talking about Jerome Powell. I'm sure he's a smart guy, but he doesn't know how to handle choose his words carefully if it's not written down. So, especially that they give us the Fed minutes later on, so we'll know exactly what they talked about. Why the heck do we have these Q&As? And he made them every month. They used to be every other month, and now they're every month. I can't believe we're having this. So anyway, Q&A came out, and the market fell out of bed. Ridiculous reaction all the way down to 29.50 something, 58 I think it flashed. So this is the candle. This is a 4-hour candle. And this is how it flashed down. So aside my rant, put my rant aside, let's look at the levels, because this is really what matters. What he said didn't change anything. They're still dovish. They're still going to cut rates if we need it. They're not going to cut rates if we don't need it. And they ended the QT. And we're going into a new month. All right, so let me mark up the levels the way I see them. First of all, what they say, what they did, how much they cut, it doesn't matter. Knowing that they will cut is really what matters. So I had, this was the first target on the dip that started this week. And they met that today perfectly. And then he came out and said, I forgot what he said. He said something ridiculous, like a change, a shift in strategy or something. Any word that suggests change, Wall Street doesn't like it. So they've been dovish, and when he says change, mid program change or something like that. And then we slashed through all the levels that I had, but I didn't lose a level because look at where we stopped. This was a target from before on this loss, but it didn't happen. So now it did. And this was a level that I had from before that, which held. More importantly, this was a level that we looked at as a bullish trigger, and it happened. So this is, to say the least, and it looks, say the least, this is a pivotal level, correct? So now I look for it as the next trigger point. If this holds, then I don't worry about anything. And if I sold put spreads or puts or whatever, they're all fine. And now we get back to watching the upside trigger. So if it comes when it comes. Where is it? First, we look at the prior supports as forward resistance. What does that mean? So if this holds and we start creeping up for whatever reason, I have to start looking at potential, anything that I had drawn as support will become potential resistance. What does that mean? It means that, for example, this level here, zone was pivotal on the way, support, and then it broke down. So now it may become forward resistance. Same with this level here. This will be a ledge that we will be looking at as resistance, 3020. I mean, we're only talking down 1%, and the VIX was up like 15%. Obviously, something is exaggerated today, and I don't act on it. Volume was pretty sizable. This is a big volume, biggest volume in a while. So this was a legit test. It will take new information, in my opinion, to breach below it. Today, he gave us whatever he gave us, and this happened. So it should be a solid floor. And we'll look at it from the other side. As far as what do I do here, nothing. Nothing that happened today was new. The levels are still holding. The statement was fine. His words after the statement, and he tried to backpedal from it, and he just kept on digging deeper and deeper and deeper. So he obviously said something wrong. If this was Draghi would come out tomorrow and say, hey, what I meant to say, you guys misheard. Blah, 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 blah. This guy doesn't know what he's doing as far as words are concerned. He might be a smart guy and knows how to manage data, but he just should shut up. He should not talk unless it's written on a piece of paper. So enough with these Q&As. Submit your questions. I'll answer them written. That's what he should do. Anyway, what's the point? So levels are concerned. These are the levels I'm looking at on the way down. As long as they're holding, nothing changes. So if I'm long Apple, I'm long Apple. In fact, probably dips today in Apple were buying opportunities. So if you weren't long Apple in the earnings spike, this was your chance to get long Apple on this dip. It still closed green, but a lot less green than before. And we were long Apple and booked it in the morning, and I shared it. So now I can go long it again. If I would do it, I would sell put spread somewhere down here. Depends on the distance. If I'm going out waiting time, I'll sell them wherever I want to. But shorter term, like late August, early September, I'll probably sell them down here. I want to hide here. All right, so this is that part of it. So how do we look at it differently? VXX, for example. This is a derivative of the VIX. This is an ETN, so it's not an ETF. So by definition, I think it should fall to zero over time because it's a note. It has an expiration date. It expired not too long ago, and they renamed it VXXB, and then they reissued it as VXXB, and then they renamed it to VXX. So what happened today at the spike was right here. I sold short in the credit call spread at 25 to see if this will fail again. So I have a short leash on it. If it starts going red on me, I'll close it. Otherwise, I'm a winner. If it doesn't go through 25 by 20 cents or so, I can't remember the selling point of it. But this is where I start looking for beyond what happened today. So this will place the bogey, and then if they can exceed it tomorrow or the day after, then this becomes some sort of a cup and handle, which is bullish, the VXX, not good for stocks. Then we will probably see that ES level breach at 29.60. So this is the other way of looking at it. Another way of looking at it is looking at the actual VIX itself. So this was the spike in the VIX, and then it faded, and then it's ramped up after hours. But what's important is where it's stopping. And just like the VXX, the high that we saw today becomes either the bogey, either a trigger or a top, obviously. So how is it a top? This was where it last failed, and last failed before that. It has been pivotal before, so it's important. It's an important spot. Onus on the bears to prove that they can push the VIX higher. So how does that happen? So if in the next couple of days it does this, and then it goes above it, then we could spike. Where to? This would be the next zone I'm looking at. But the VIX usually goes in big bursts like this. So technicals do play in, but it's more so watching levels instead of just guessing how far up it can go. I remember the days when the VIX spiked to 90. This is 22 up here, just to give you perspective. That was the during the 08 debacle. Yes, 90. So we recently, I think we've seen it 40. Not recently, in recent history, I should say. So unless they can breach above this, I'm not that worried yet. And ES should hold. The S&P should hold. All right, so what happened today? Today, the market makers were in wrong. What does that mean? The open interest showed downside pressure, meaning there was a lot of positions that needed to chew themselves up. On a wash like this, I bet you a lot of those positions traded hand. What does that mean? It means the retail sector panicked and started buying puts, and the market makers got out of their puts. So now the market makers can go ahead and screw the retail people by not making anything happen much more than this. And if that's the case, they punished a whole bunch of people that panicked today. We shall see. I think we need another incident to go much slower than this. Now, the argument against it is this. So if you believe in Fibonacci, and this is the S&P, we're looking at the SPX now. This is a giant rally. Usually rallies go up and they retrace. How much? It depends on the risk appetite. So this is about 50% eyeball. I'm just eyeballing it. 50% of retracement. So if you've heard of Fibonacci and you believe in him, we could trend down to 2920, 2900 SPX. I see this zone as pivotal, so it should provide some support, and this zone definitely as pivotal because it was the place of jump and then support. So if I were selling puts and put spreads, I'd want to be down here. It depends on the time frame. If I'm going way out in time, I'll go do it down here. So this is the other way of looking at the opportunity here. If nothing changes, these words don't change the facts that the Federal Reserve is still concerned about global growth, not in the U.S., global growth, and the data is bad out there, not in the U.S., we are still hanging on good. They're taking this as an insurance cut in order for not let the outside stuff bleed into us. But they caused a big rip in the dollar, which is pretty strange, given that they did cut rates. But apparently, this says buy the dollar. It just doesn't make sense. Relatively speaking, we are still less accommodative than outside countries, so maybe that's the case. But anyway, today's words, not the action, is what hurt, and not just words. The spontaneous words, the ad libs, are what hurt the market. Otherwise, the market would have been just fine, and that would have been a reason to buy. If there's no new news, I think the upside move is the default move. This is a 2-hour version of what we looked at earlier, and you can see that there was a clear rejection of this and then some sort of a dip after hours. And look at this. I mean, I didn't make this up. These were drawn days ahead of time. So they're back into play. So as long as I can see levels that I can make sense of, I'm not panicking. I'm not changing my mind. This doesn't mean sell Apple, run away, sell Google, run away. There's still 18, 22, 26 PE. Some of them are below 10. So we're not bloated. Just I keep my head down. I ignore the pundits. I look at the levels, and I have my own thesis, and I trade accordingly. So even if we fall down to 2,900, even 2820, if I remember from previous levels I've discussed, I'm still okay. So this is a 5-year look. This is 2,800. So not a giant debacle. We're still in a bullish phase. Nick signing out. This is way longer than I wanted, but I think it's pretty important.